Hey Shane, how's it going?
Very well. Back in the office today. Um, Conference was good last week and made it home safely.
Awesome. Well, glad to have you back. Today's April 14th and Mountain Standard Time. It's a little after 10. So kind of watching the market. I don't expect a whole lot today. Tomorrow is a holiday, so it's Good Friday. Markets are closed. So today we're going to see the close for the weekly candle. And daily obviously, but I guess the first thing I wanted to just point to starting off, so I've got SPY up on my chart here and drew a couple key lines here. And this is what I'm seeing. So right here, this is a level where the last few days, we need to take out the prior highs and we're just not there yet. We break that, thumbs up, I'm bullish. And, looking technically, we've got potentially a reverse head and shoulders pattern here. So you got a shoulder here, head there, right shoulder. But if it breaks this line, and I think that's where I'm leaning, I think
the
we've
yellow
got,
line, you mean, or the
yep.
green one?
So we've got this bottom green line, we've got this
Yeah,
thumbs
yeah,
down. If
yeah.
we break that, it's down from there. And just to kind of point in and read the tea leaves a little more, if we look at an hourly, this is that downtrend resistance line. Here we are today, and we're about to take out the lows of the day. And I think what we see probably is a little consolidation here, and then come Monday, it's going to make a move. I'm leaning towards lower, but we'll see. But I just think with a 3-day weekend, you're just not going to see that big move happen on a day like today. People
You know
just
what? I
don't want to
just
take risk
realized,
like that.
I just realized as you were talking that today is monthly OPEX, which is real weird to have it on a Thursday. But yeah, depending on how options are positioned, I mean, next week we're in the clear to make a big move one way or the other.
Mm-hmm.
I definitely am leaning towards down. I was just telling you, I guess, before we click the record button that I see everything through my bear goggles right now. Not beer goggles, bear goggles. Everything I see is a short. I just don't see a lot of reasons to be long, including in the SPY. I mean, I don't know about that inverse head and shoulders. Is that what you were drawing earlier?
That's what we're
Where was
looking
that?
at
Oh yeah, just
on
put
the
that on the
daily.
daily. You have like a little so on the left hand side, you see the paintbrush, like in the pane over there. It's like right. No, go up.
Oh,
It's a paintbrush. It's like the
I, th-
third one down on the left hand side.
I think your head's in the way on the recording there.
Oh, there it is. That's the paintbrush. Just grab the paintbrush. Nope, top one, dude. Yeah, there you go. And then draw yeah, there you go. Uh-huh, yep.
So, the measured move off that, you measure off the neckline from the head. So that would put us kind of up in this area, but we'll see how it unfolds. I'm just not seeing it right now, or at least if I was trading or taking a position, this isn't a spot, especially on today. It's Thursday. We got a 3-day weekend. And this is probably going through the minds of a lot of traders. They're not entering this position here, banking on this and holding it over a 3-day weekend.
No, man. I mean, we just dipped back below the 50-day moving average, which is the red line there. We're still under the 200-day moving average. There's a lot in the way of that head and shoulders or inverse head and shoulders working and then going back to the highs. I don't know about you, man, but I don't trade head and shoulders patterns. I don't trade inverse head and shoulders patterns. I don't trade regular ones. Every time I've ever tried, I've always lost a lot of money doing it. So um I don't know. It's a very popular pattern because it's just like so obvious when they show up on charts and it's an easy thing to talk about. But I don't trade those patterns. Do you trade those patterns?
I will, particularly on like a shorter time frame, but it's always what are we looking at for the risk reward in the situation. And like I said, buying before a 3-day weekend, banking on something like this to happen when, let's just look at a couple things. So on the daily, here's the 200, here's the 50. We're under both of them. And then if you go to the weekly, here's more zoomed out version. Cool that there's this pattern, but look at this. We're about to close another weekly lower. we're below all key averages.
So that's
if you're a
that red
gambler,
one's the 50-week average now.
right?
Yeah.
If you're a gambler, have at it, but this just isn't lining up. And, if you have existing money, that's one thing, but new money to work off of this right now, it's just not a spot where I'm going to be throwing my hat in the ring.
Is there a reason that, like, is there a logical reason that these head and shoulders patterns develop or play out? Like, and like when they work, I don't, did they teach you anything about that in the CMT studies, which I've not done, obviously? Like, do you know
So
offhand, like why, like what the rationale is for that?
a big part of it here is that you get this left shoulder forming, you got high volume, and then here the bears push it down a little further, but they just can't really set a substantial new low. Pushes back up. So now you have two areas of major volume. So this is coming into a big, volume support level where there's a lot of people holding. So I guess the idea is you'll have more institutional money, or the big money comes to the table right here and kind of pushes it back out because they've accumulated their positions down here.
I see.
But it's one of those things. Technical analysis, I say, is more of a measure of risk. It's never an absolute. So
Yeah.
every pattern is bound to fail, no matter how good it looks. And on a day like today, you got everything is under all the moving averages, and then nothing new here, but just on the sector level where we've been talking about, 48% of all holdings in the S&P still below 20-day. On the 200-day, still at 49%. It's just not a great spot. If I want to pick my place, this just isn't it.
Yeah. No, man, like I said, I've never made any money on a head and shoulders pattern. I just don't, I just overlook them now. They're not interesting to me. It's a good way to lose money in my opinion. So, I know they're very popular, but I've never successfully made any money trading them, especially in a big index, maybe in a smaller stock or something like that.
Right.
I don't know.
And this is one with those averages. For me, I'd like to wait for that confirmation. Give me a daily close up in this region, and then I'll start to get interested. But
yeah, right. Yep, I'm with you there.
That's about it. What other, so on the macro level, should we go ahead and take a look at the cues?
Yeah, go for it. Yeah, you want to pull up cues? I can pull it up, whatever.
So we're not looking any prettier there. What are your thoughts here?
It's a good question. I've made more money shorting the Qs this year than any other ticker symbol I've traded. I was actually just talking to Ken about this. I've shorted the Qs, and I short TQQQ, so the 3 times leveraged version of this, but I use this chart to do it. So I don't really care what the TQQQ chart looks like. I look at this chart, and I short it. I short TQQQ when I want to short Qs because I get 3 times the move. And so I've done it a whole bunch of times. I'm currently still short the Qs via TQQQ, and I'm up a bunch on it, and I've only covered 30% of my initial position so far, up about 10%. And I mean, I just think this thing's going way lower. It rallied into the 200-day moving average, and just it twice got rejected essentially there at the light blue line. Now it's decidedly below the 50-day moving average, which is declining again. I just think this thing looks so bearish, and none of the constituents really have any momentum behind them anymore. There's no value in these stocks. They're not trading at discounts to their intrinsic value, and they don't have any upside momentum. And so I don't see any reason why there should be any material upside here. And you see, like, look at the last 4 candles in a row. Look how big the bodies on those candles are. Like,
Yeah,
I don't, there's something wrong there. Like that is abnormal. And when it's abnormal like that, there's just no good reason to make a big upside bet. I think there's more reason to be cautious, and if anything, bet on further downside. So, we might not go straight back to the lows there at like 316, 317. It might take some time getting down there, but I don't know, man. We dropped from 370 back down to 341 here, pretty quick. And I think that bounce from the lows all the way into the 200-day moving average was largely driven by, pension funds rebalancing and having to buy some Apple and having to buy Microsoft, having to buy the big players because in the first quarter stocks were down. And so if you have a mandate to have, just as an example, 50% of your fund in stocks and 50% of your fund in bonds, and the stocks are down a lot, more than the bonds even, then you have to buy stocks going into the end of the quarter. It's just like a forced buying situation. And so I think we just saw a lot of forced buying into the end of April. And once the calendar, like if you draw a vertical line on April 1st,
Yeah, it's like right in there.
yeah. Well, why don't you get the line, the vertical line? Like you've got your drawings up there in the top left. You've made it a favorite and everything.
Your head's getting in the way again.
Still fine.
It's
Yeah, you
just too big.
shouldn't put that, like the tool tray there. There you go.
There we go.
Vertical line. No, it's the one that looks like a vertical line. So there you go. I mean, you saw a whole bunch of buying into the end of the month. And I don't know if I said this on this call or not, but the fact that there weren't enough buyers to go all the way through March 31st, to me was just a very bearish sign. Like all the forced buyers ran out of buying power before the month was even over. That to me was just like, there's not going to be any buyers left come April because all the forced buyers are done by then. Who else is left to buy, And so basically for all of April, we've done nothing but sell. How far are we down? Can you use the info line there to like see how far we're down since then on a percentage basis? Info line's all the way on the left. There you go.
So
8.83%.
yeah, about
for the
9%.
lows. Wow. Yep, that's pretty much what I expected. So anyway, I'm staying short.
Yeah. And this is one again, look, there it is, reverse head and shoulders, but I don't like this. So you had this really nice rally, that green candle, and we've almost retraced the entire thing so far. The day's
Yeah.
not over, but
That rally yesterday was right after a bearish engulfing candle, which is usually bearish, right? Like usually leads to more downside. And even despite the giant rally and green candle yesterday, it still didn't get above the highs on the prior day, So like, it looks pretty nasty to me. I'm very bearish.
yeah.
I reserve my rights to change that sentiment on the fly, but for right now, I see a lot more downside coming.
Yep. And here we are again, back to the weekly. We're going to close another lower week here, and I just don't see a ton of support right here other than, if that left shoulder holds, but I think it's a coin flip at best right now. It's just not a trade that favors you.
Yeah.
So, the next thing, so crude oil, that's been kind of a big one we've talked about. Let's see where that's at.
No, you don't want that one. Do CL. And then, yeah, that should work.
We'll go to a daily here. But what are your thoughts on this one? This one's been, huge move. Now we've got a lot of volatility stepping in, but.
Yeah, I wonder if you couldn't make that, the ticker, which is in yellow, if you can't, like maybe just change it to a light blue or something, because it keeps catching, I can't see the candles that well through this. Like just right click your screen somewhere. Go to settings. Symbol, no, it's not symbol, it's appearance. Appearance is in the middle on the left. Watermark. Yeah, make it like blue. I don't know. Maybe it just needs to be more transparent. I don't know. It just keeps like catching my eye instead of the candles.
Yep, I get
Anyway,
that.
it's all good. It's all good.
So here's kind of, that's what I was looking at. So I don't know if you've been seeing that, but I just see this massive ascending triangle setting up here.
Yeah, I'm trying to stay long crude. I got stopped out of the 2 times long crude or 2 times long energy sector. The ERX, which is the levered XLE. And so, yeah, I'm trying to stay long crude through the drillers. As I think I've told you, I don't trade crude itself, but I think it's going higher from here. And it just looks like a pretty perfect pattern. Looks like a nice perfect breakout right now. And holding above the 50-day. So yeah, I think we go higher from here, despite everyone's best efforts to try and release strategic petroleum reserves and all the kinds of things that they're doing. It's just not going to help. Crude's going to go higher, it looks like to me. Whether it puts in a brand new high, I don't know. But I don't, shoot, in 2008 it went to 145, so it wouldn't surprise me at all to see crude move all the way from 104 to 145 and put in a new high for this run. So nothing would surprise me, but the trend to me is definitely to the upside from here.
Absolutely. And that's, what I'm seeing here is after this massive move, it's natural to have some consolidation. So we're just seeing that, here we have this break out of that trend line. So it could be something like, down here, retest, and then something like that. And, we'll see where it goes. But I think that despite pouring out the strategic petroleum oil reserve, which I think is just a terrible idea.
Yeah.
Politically, it's nice, but it's like emptying the reserve on your gas tank. It's, when you run out, it's nice having peace of mind that there's that switch you can hit on your ATV or whatever it is, and we're emptying that. So I don't know. It'll be interesting, but yeah, if I'm betting higher, and I wish I had a tank at home I could fill up and be ready for this summer, but looks like I might just be paying higher, or I could hedge it and
Should have
buy
taken
some
delivery
futures
on a whole bunch of barrels of oil when they cost negative money, and they were just giving them. They would have paid you to take the oil, a year ago, and you could sell it for over $100 a barrel now. Pretty crazy.
Yeah, unfortunately,
You can't even do the rate of return on that. It returns, not NA. No way to do that math.
Mm-hmm. And here's just another, while we're hitting the oil market here. Look at this. We talked about this last time.
Ooh,
We thought this was prime spot for a double top, and it's not over now. Here we are. It looks like it might have pulled back for today a little bit again.
What is that? That can't be the right chart. Is that the right chart?
No, this
can't be. Yeah, because nat gas is up again today. That the
yeah, it's
Macon
up a
chart
heck
is
of a
up
lot.
anyway.
Let's see what do we have here.
Hit the caret on the left of that. Right there. Yeah, you want the Henry Hub. I don't think you're on that one. There you go.
There it is.
That's what it looks like. Yeah, I'm waiting for that red. I was like, wait, did I miss it? Because as soon as it puts in a red candle like that, I'm gonna try and short it. I can't wait to short this nat gas over $7. I mean, the higher it goes, the better right now, especially for the ability to make money on the short side. But this is ridiculous. This is a crazy move. They don't call it the Widowmaker for no reason. That's what they call nat gas, is the Widowmaker. But man, I'll tell you what, I looked at buying BOIL, BOIL, the 3 times levered nat gas ticker, like a week ago, or maybe when was it? That last breakout. You see the like right around $56. There's like this crazy weird green candle, like on February 1st. Yeah, see that candle? Yeah, I mean, when it broke above that recently, like at the beginning of April, I very seriously considered buying it, but I was like, nah, it's not going to keep going. Draw a line from there up to where it is now. I think it's up like, I don't know, 40% or something, and not that long, dude. Like we're talking like half a month. Yeah, like somewhere in there. 66%. Even from that gap, from where it gapped up, right? Like that's just crazy how that move. I'm going to short this BOIL. This is what I'm going to use to short nat gas when it's finally time to short. I'm going to short this thing.
Nice. And it's funny. I have this conversation a lot with, people. I think when you're new to the market, especially, you want to catch a falling knife. So you find something that looks like this side of this runoff and try to pick the bottom.
Yeah.
But it's amazing if you just go for these kind of no-brainer momentum moves, how far they can go and how more consistent they are than trying to, pick a bottom way down here after a large sell-off.
Yeah, we don't pick bottoms that elevate. Picking bottoms only leads to smelly fingers. Have you never heard that one before, Kyle? That's funny. You can laugh at that. That's a
Well,
joke.
I've heard that one. So let's go to our other commodity here. So here's gold. This one, we've been talking about it, and it always goes back and forth. If you zoom out to like a weekly chart, and we'll just do that real quick, it's one of the best looking charts out there in a way. You know, you had this large run up, just this kind of massive consolidation bottoming, and then cup and handle formation, they call it. But you get this next little cup, and then now looks like it's finally breaking out, and I'm pretty bullish here. But what are you thinking, Shane?
Yeah, I just see a new flag. I mean, it's just a perfect flag breakout. There was a longer extended one, and now there's just a shorter term one, but it looks to me like it's going to break out and go higher.
Mm-hmm. Yeah, this is kind of the level I was watching. So I think that's 1970. We broke through that, doing a little bit of a back test here, and then likely to continue higher, I think.
Yeah, I can't draw anything, so I draw stuff I think a little bit differently. Let me see if I can just request drawing capability from you real fast.
All right, I think you've got it.
Let's see. So this is the daily. Well, you had the weekly. Let's look at the weekly real fast. Oh, no, it zoomed out way too far. Sorry, give me 1 sec. So anyway, to me, there's a nice breakout there. So that to me is a flag. There's a nice big run up from here to here, and then it consolidated all around in this area, in this triangle here. And you just on a smaller time scale, you see the same kind of thing happening, just over the past few weeks. I'm gonna get rid of your green line for a second. So if you zoom in on the daily, right, you're gonna see essentially the same pattern, from here to here, and from say here to here, and now we're gonna do it again. So I just see it playing out on a shorter time frame. If we zoomed into hourly, we'd probably see it again,
Mm-hmm.
And so gold just takes a little longer. It's a little bit of a slower mover than some of the other things. And I've been trying to buy this breakout in a whole bunch of different ways. I keep getting stopped out of it because I keep my stops relatively tight. So I don't think I'm in any gold right now, personally, but I think that's going higher. I think it's going to make a new all-time high. I think my buddy Scott's going to owe me a bottle of wine. So, so we'll see how long it takes to put in that new high, but there's definitely some upside there. I mean, we're still under 2,000, and only 5% or so up to 2,100. So that's not that much. Gold can go that much higher easily.
Yeah, absolutely. And it likes to move pretty quick when it catches a bid sometimes. So we'll see. And then what about, let's see here, Bitcoin. I guess we can pull up the futures. Same thing. Oh,
Nah, you don't want the futures. You got to go to the crypto. So for anybody who's paying attention, do type in BTC USD and use the Coinbase one, because that's where 99.9% out of these people are going to have their money. So nope, you want the second one. It tells you the see the second one. See how it says Coinbase on the right? You went too fast, but it tells you which exchange,
yeah.
right? So make sure you use that one. I mean, that's if you trade somewhere else, by all means, look at the other place. But yeah, I mean, Bitcoin futures don't trade on Saturday and Sunday, so the moving averages are all wrong, because Bitcoin trades 24/7, 365. There's no days off, and the 200-day moving average is based on the past 200 candles. So futures just doesn't ever line up correctly with the actual charts. So you never want to use the futures unless you're actually trading the futures. But I don't know a lot of people who do that. Contracts are pretty expensive.
Yeah, I think last time I checked, margins were 80,000 or somewhere in there. So it's pretty high.
I'm gonna zoom out real quick. The line you just drew is actually dude, it goes back a bit further. If you drag this thing all the way out here and just bring it down just a tad, that's kind of how I see the trend right there. And from here back to here, you know, there's that's the low. I mean, we're below the 50-day, below the 200-day. Perfect tag of the 200-day moving average here before, you know, dropping like 20%, no, 17% from the 200-day. So I mean, this thing could just keep squeezing, you know, off of this rising yellow trend line. But with the 200-day moving average overhead, I wouldn't get too aggressively long until we're above the 200-day moving average. And if it breaks below this level, the downside target for me would be, you know, roughly another 20% lower, down to about 30,000 bucks, before you would find a lot of support. Arguably, there's some support right here too. Um, but yeah, for now, I mean, if you want to try and play the bounce, you know, I think this is kind of at the low end of the range. If it were me, I would be putting a stop right here at this yellow line, because if it drops below that, chances are it's gonna keep trending lower. So I think Bitcoin is going up in the long run, but in the short run, no, you know, there's no need to get crazy aggressive down here, because if you just wait for it to break actually above the recent high and above the 200-day moving average, there is plenty of upside, right? There's 40% upside if you buy it here. And you're in a much better position, like, you know, like you were just describing, not trying to pick a bottom, but actually buying the momentum that's there. So
Right.
if it breaks back above the 200-day moving average on big volume, that's where I'd want to buy it, and then play it for a run back to the all-time highs, or maybe even higher. So that's the way I see Bitcoin right now. I think, you know, in this little pattern below the, you know, above the yellow line but below the 200-day moving average, I think it's kind of range bound.
Absolutely. And holding a position like that's tough too, because when you range bound, you know, you always talk about mental capital, and you end up paying attention too much and it just starts wearing you down, and you finally just throw in the towel before it finally makes the move. So
Yeah,
much
and dude,
easier and stress free to just wait for it.
it's not like it's a tight range either. I mean, from here to here, it looks like a tight range because the chart is so volatile, but that's a 26% increase. And then we already looked at it as a 20% drop from the 200 to where it is right now. So I mean, yeah, it's in a range, but that range will shake a lot of people out. Like, if you know,
Hmm.
you can't put big money to work on a range like that. That's just a good way to get chopped up. So so I don't think it makes a lot of sense to get aggressively long Bitcoin here. If you don't already own some, I'd buy some. Um, but for a trade, I would wait until it's above the 200-day moving average before getting aggressively long. Like, look what happened over here when it jumped above the 200-day moving average on, you know, some nice big green candles. It just kept accelerating to the upside and went up 48% in 38 days. So that's the kind of stuff you want to buy. You don't need to pick the bottom if you're going to get that kind of a move.
Absolutely. And, you know, no surprise when you get a big move like that, right here, you always get those little consolidations. Great spots to enter. You know, the
Yep.
risk reward there is very favorable. You can put a tight stop in and you already know where the momentum's going. So you just hop on board.
Yep.
So, well, you know, why don't we turn to rates? Talk about that. I know that's been a hot topic, and then we can wrap up and just, you know, any kind of market commentary questions or high level ideas.
Yeah. What time are we at right now? How long have we been on?
I've been on for, I think, about 24 minutes or so.
Yeah, cool. I'll try and be quick with the rest of this. Do you have the mortgage rate chart? You want me to share mine?
Yeah, why don't you, if you want to just take over.
All right. How do I do it? Let's see. You got to stop sharing your screen so I can share mine. Here we go. I guess mine's going to show you cues first. Let's see. Do some economy. There's the symbol. Mort gag. Mort gag is the symbol. Oh wow, I haven't drawn the line on this one yet. Let's see. Let's get these moving averages off of here. In fact, let me go to my economy chart. There you go. Oh, that's ITB. Wow. Yeah, which by the way is going to go opposite of mortgage rates, as I mentioned in my commentary. So yeah, this is, I think we looked at this last week, but since 1987, right? This is a trend line since 1987 that's been in place, and we've recently kind of broken above this downtrend of lower highs. So we're kind of out of the downtrend now, and when a I guess roughly a 40-year downtrend breaks, is that right? No, 30 years, I guess, closer to 30 years. We could be going up for a long time. No telling yet. 4.72 is where we are now. I think there's probably a little bit of resistance that'll kick on around 5%. But if it breaks through 5%, I mean, we could easily shoot up to the 6.8 range. So this is the scariest chart in the market right now. I think it's already slowing down the housing market quite a bit. I don't know. I saw something this week that second homes are, pretty much done being bought. There was a big rush to buy second homes during COVID, and that has all but stopped. And the higher these rates go, the less affordable homes are at current prices. So sellers will have to start discounting their homes. And you also have the situation where if you sell your home right now, right, assuming it's your only home, and let's say you're in a your current home is, you're up, you bought it, $100,000 ago or something like that, and your interest rate is 3% or 3.5%. Well, if you sell that home today and try to roll your gains into a new home, you're going to have to pay a much higher interest rate. So a lot of people are probably just going to decide to stay put. Which is interesting because there's not a ton of housing inventory out there. So it's hard to say how this will play out, but the higher these rates go, the worse it is certainly for home builders. There's just less people who can afford, or less people who will even get approved for a loan at these higher rates, because wage growth just hasn't kept pace, with the interest rates. So I think this is a pretty scary chart, especially if you're a home builder, and that's what you saw on the screen when I first launched it. This is the home builder ETF ITB, and it's down 30% since December 31st. I think you could actually probably overlay.
And it'll be interesting. It's like Japan. They were one where their rates went sideways forever, and hey, that could happen with us. But if I'm just reading the chart and sticking to what I know, that is one where it's broken out of that downtrend resistance line and seems like it wants to go higher.
Yeah, look at that. So ITB is down 30%. Meanwhile, mortgage rates are up 49%. So those are inverse correlated. If rates continue higher, the home builders are probably going to continue lower. So something to keep an eye out for. Economically, we've got the 10-2s as well, which is no longer negative. So the spread's no longer negative there. We've got a nice little bounce in the 10s-2s. So that's good, but we were briefly inverted, and that generally leads to a recession within about 18 months. So the recession clock is ticking. There are a number of other reasons to think a recession is all but imminent, particularly energy prices. And so, we don't know when exactly that will begin. May have already begun. Won't know until after the fact, unfortunately. But yeah, there's a lot of reasons to be bearish in the market right now. That's why I keep shorting the Qs. That's why I'm still sitting pretty heavy cash personally, and in the elevate account strategies. And until the Fed changes their tune and tries to step back in with some type of accommodative policy, I think there's lots of reasons to actually stay bearish.
Absolutely. And I think for me, just on a high level, I'd like to see energy pull back. It's just, a little alarming when you're seeing rates go up like they are. You've got commodities that everybody spends their money on. Price of those are all going up, and it's just starting to pinch a lot of budgets. It's just not a great setup, fundamentally for the markets. And then if you're doing the trend, it's kind of like what we started with, is that we are under the key moving averages. So right now, just it doesn't mean the world's ending, but it just doesn't mean also it's a great time to be putting new money to work.
I've never actually looked at this chart. This is the blue line, in the area is the central bank balance sheet, all the bonds that we bought. This was in 2018, when we actually started unwinding the balance sheet, the last quantitative tightening. And during that time, the market actually, dropped quite a bit from, well, I guess even from up here as we were tightening, as the Fed was tightening and letting some of those bonds roll off, the market dropped by almost 20%. And then they cried uncle. And then then COVID happened and we really got to work buying assets. So, I mean, it's crazy to think that over here, this is all we bought during the great financial crisis, right? And then COVID happened and we bought all of those bonds. Like, wow,
And I remember when TARP happened, and I think it was 800 billion, and it was jaw dropping to think that the Fed would drop that kind of money, or the Treasury. And now, what was it, 6 trillion is what they printed. I mean,
that's what they did on the first rip. And from there, I mean, they just kept buying bonds. Like, they bought all those even after COVID. So they were buying these bonds all the way until basically March. And we all knew that inflation was out of control for like the last 6 months. Like, anybody who's been to a grocery store or to a gas station, we all saw this happening. And the Fed was meanwhile talking about how inflation was transitory. And meanwhile, they're out there buying these bonds, forcing more inflation. I mean, it boggles the mind. I mean, I don't know why anybody trusts anything that those people say at the Fed. I mean, we have to pay attention to what they say, but I mean, I don't know. You can't count on them to do anything useful. That's all I know. And every time they bail out the market, they just create a different problem, that will be addressed later, by some other people in the future. And so I don't know. For anybody out there that read the commentary that I wrote recently, I mean, what they ought to do is just leave the economy alone. And there's this thing called the economic cycle, where we have periods of growth and we have periods of contraction, and trying to, what the Fed has been trying to do is dodge those periods of contraction. And they do it artificially, and they make the recession worse when it finally arrives, because there's no way to escape the economic cycle. There are ways to delay it and turn it into Frankenstein, and I don't know, but there's just no way to have all of the periods of growth without accepting the periods of contraction. It's just how it works. It's how it's always worked, and it's worked out really well, by the way. In the United States of America, we have a pretty good quality of life. The economy works even though sometimes it has periods of contraction, and trying to eliminate those really only makes it worse when they finally arrive. So what I wish they'd do is just leave it alone, and let the market, let the economy sort of stand on its own 2 feet. And certainly there are sometimes extenuating circumstances, but every time the stock market drops by 20% is not an extenuating circumstance. That's not a reason to come to the rescue of the stock market. That is a healthy situation. Sometimes companies that aren't producing profits should actually go bankrupt, and all the people that work at those companies should be out of a job until they find a new one at a company that is adding value for society. That's the cleansing of zombie companies is something that is actually good for the economy. There's no need for us to have S&P 500 index and NASDAQ indexes that are full of companies that can't even earn enough money to pay the interest on their debt, when the interest rates are only 2%. I mean, if you can't afford that interest, you shouldn't be in business doing whatever it is that you're doing, and you should go bankrupt. So That's my rant for today, but it's really annoying. And when that finally does come to pass, it's going to get ugly. So maybe it's time. Maybe it's time for them to actually let the market stand on its own 2 feet, reduce this balance sheet back towards zero. We won't get to zero for a very long time, probably not even in my lifetime. But there was a time in the world where the Fed did not have any assets on its balance sheet. It did not buy bonds to artificially keep interest rates low. Like that was a real thing, prior to 2000. That was a real situation. And there's no reason we shouldn't go back to that, because the United States of America has seen the biggest growth in its history when the Fed was staying the heck out of this.
Mhm.
So
Yeah, so we'll see how it all resolves, but it's just, I mean, I don't even know what to say when you see a line like that and you understand that it's the Fed pumping money into the economy, and you just wonder what assets that's all going into and how unaffordable will the world be for those who didn't own assets at the beginning.
yeah, it definitely hurts the poorest Americans disproportionately. It promotes the expansion of the income inequality in this country, and it's really just shameful. I think history will look on it less than favorably. A couple of decades, certainly a century from now, I think they'll look back and say, "What were they thinking?" That's what I think.
Yeah. So, well, I suppose with that we can wrap it up, and it's a 3-day weekend ahead. So I hope everybody enjoys the extended weekend. Happy Easter, and we'll see you next Thursday.
Thanks, Kyle. Happy Easter, man.
Yeah, you too. Have a good one, Shane.
All right, see ya.